Okay, we'll now call this meeting of the Retirement Board to order. Going to number 2, public input and board communication. Does anybody have any communications to share? And well, so I don't forget it later, I'm going to mention that this is Dennis O'Brien's last meeting. He's gotten too busy. I know he's swapped, but I do thank him for all he's done and for all the time he's put in, and wish him the best.
Thank you, John. Appreciate it.
Wish you well, Dennis.
Thank you. Appreciate it.
And then Cindy's going to give or take questions on her report. Hold on a second.
Hello, everybody.
Hey, Cindy.
I didn't get
Hey,
the,
Cindy.
can you hear me?
Yep.
Yes.
Yeah.
Yep.
Oh,
You
okay.
froze for a second.
Sorry. Okay, so this being the first quarter of the year, you'll see that the employer and the employee contributions are in, so that's why the revenue, and plus the gains and the dividends were up, but the revenue right now exceeds the expenditures of 2.6 because we've only had 3 months of pension payments. But most of the expenditures will come in later in the year. So it has, you will see at the bottom, the reconciliation to the SEI statement, which is just basically the DITs that we have and a little bit of an accounts payable. So I'll
Okay.
take any questions if there are any.
No, looks good to me.
All right. Well, thank you very much. I'll turn it back over to
Cindy.
Brian.
Are we in video?
No.
Oh.
Oh.
Was there a question or was that just someone say their name? Okay. Hopefully everyone had a chance to look at the minutes from August 26th. And I'll entertain a motion when someone so desires.
Move we accept
So
the minutes.
moved.
Jason, was that you that moved, and Carol's second?
No, it wasn't me.
I moved it, John.
Mark? Okay, got it. And Carol's second. Any discussion? All in favor, say aye.
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 Okay, minutes are approved. Authorization of payments from the retirement fund for retirement benefits, and there was a correction for David Smith that was sent after the original packet.
You know, this date says January 4th. January 1.
That's the difference.
No, he was in December
Okay.
31st.
Okay, I will entertain a motion for this block if somebody so desires.
So moved.
Okay, Dennis moves. Do we have a second?
Second, Jason.
Jason, okay, any discussion? If not, all in favor say aye.
Aye.
Opposed, same sign. Motion carries. We'll move on to SCI.
Okay, great, thank you. I'll share my presentation here.
And one thing to point out on page 3 of the Town of Groton Executive Summary in the SCI, it says it's still at the 7.25% actuarial assumption rate. We
Right.
did change that to 7.0 in May.
Okay, correct. Actually, I have that note, and in the presentation I'm about to pull up, it was corrected.
Okay,
So actually, let me share this here. Okay, I'll put it in slideshow mode so everyone can see it better. How does that look?
Good.
that's good to
I
me.
can see it. I can see
Okay,
it.
great. Okay, well, I can't believe we're already in the middle of November here and Thanksgiving is next week and the end of the year is fastly approaching us. So hope everyone's doing well, staying healthy. And I'll be relatively quick today. I want to hit on some key points, some key themes that have happened in the quarter. Some of those themes, some things have been resolved and some things still have not been resolved. So we'll touch on those briefly. So as you mentioned, John, we changed it to 7% here. So I apologize. We caught that after the fact, after we said it. So that's been adjusted. The important thing here is we've been achieving that goal for very long periods of time, in excess of that goal. If you look at the trailing 5 years, almost 10.5% there for trailing 5 years. So I wanted to show you September, and then I know a lot, sometimes you guys ask, okay, well, what's the current value? And so I have both of those numbers for you. So we have through September and then through October, the portfolio is about 155.7 million at the end of September. And then at the end of October, it grew to 160.2 million. So we had some growth there in the month of October. As you can see, there's a pretty strong month at 3.37% positive for the total portfolio. I have some notes here. You can use those for your minutes, but I'll speak to these notes as I go through the presentation. So on page 6, just a general look at the overall broad indexes in the markets. You could see on a one-year basis, we had very strong markets, small caps leading the way, outpacing large caps, international and emerging markets. Commodities was the next big winner. We've been talking about that last meeting, was actually doing pretty well as well. It's been a long time since we've seen that kind of return in commodities. So we're seeing it. I'll talk a little bit more once we get to the fixed income section as to why we're seeing commodities do so well and what the environment is today. But as a whole for the year, commodities, small caps are the leaders. When you look at it for just the third quarter, equities are relatively flat. So we had flat to negative returns in equities and the same thing in fixed income, flat to negative returns, although commodities actually had the strongest performing quarter as well. So the US equity market, we've talked about that value growth story. Value over a one-year basis is leading growth. So we've seen that happen on and off depending on the quarter. 1 month or 1 quarter growth might outperform, the next quarter value might outperform. All in all, over a one-year basis, value is leading the way. For the quarter, actually value underperformed growth by a small amount. They're both relatively flat, but you can see that. The important thing on this slide is the sectors. What we've been seeing over the last several meetings that we've met is we're starting to see a rotation on this bottom graph here. So for the last 4 or 5 years leading up to mid-year last year, we saw that technology sector on the left-hand side. So if you're on the left, you're doing the best. This is based on the third quarter numbers. Now we're seeing things bounce around. So financials, utilities, they're on the left now. They had some good performance. And then we're seeing areas, other areas move to the right. So that's a good thing for a couple of reasons. One, we're not just dependent on 5 big name stocks anymore. You're getting benefits from other parts of the portfolio. That's important from a diversification standpoint. Secondly, we're starting to see rising rates. So financials typically will do better in that environment, in a higher interest rate environment than some other areas in the markets. So that's one part of the reason why we saw financials do well in the third quarter, for instance. Also, what we're seeing in the markets, and I looked at this as of October 31st, and I'll have to get more recent numbers, but corporate earnings are becoming much more important, right? So before, everything was being held up by Fed stimulus, monetary stimulus. It didn't matter what was happening with the individual companies per se. Even if they had a poor outlook, they still might do pretty well because of all the stimulus. Now, we're talking about the Fed tapering now, potential rate hikes next year. I'm getting ahead of myself a little bit, but the Fed and monetary stimulus is slowly tapering off, and eventually it will be there, always be there to support the markets, but it's not going to be there to the extent it has been. So what's that mean? Corporate earnings are going to be huge going forward, and they have been thus far. And believe it or not, we've had very good corporate earnings. So I looked at it as of October 31st, 56% of the companies were in. About 82% of those beat on earnings per share, And I think it was like 70-some% beat on the revenue projections. So, we saw a pretty good pop in October with some of these equity returns as a result. October, and now we're in November. So we're starting to see some good returns come in from earnings perspective, and that's driving the markets higher. So the better earnings you have, the better outlook you have. If you're hitting those targets, you're getting benefited for it now. You're not just going with the entire market, no matter what happens. So I think that's very important. And that's going to be key going forward as well. Any questions about US equities?
One thing, Pat, if I can add one thing, and you're probably going to hit upon inflation, in a bit, but obviously one of the factors in what we've seen in the fourth quarter equity run-ups, which is actually pretty spectacular, is the part of the reason why the pension plan assets have grown so much, is that earnings really have overtaken inflationary concerns. But ultimately, if in fact wages are increasing, for companies to maintain those earnings, they're going to have to add on to the price of their goods and services. That's an additional inflationary spike that may not be transitory, that may be somewhat permanent, and that may ultimately impact on earnings going forward. So we're talking 2022, probably into 2023, but something certainly to be concerned about and look at, as we go forward. So sorry, Pat.
Thanks, Ken. No problem. Yeah, I was basically going to touch on that a little bit. Thanks for explaining that. So we've heard the word transitory quite often, but we're seeing inflation. The last report, I think, was 6% year over year. That's the highest in 30 years, that number. So we're seeing, I was going to touch on this on the fixed income side. Might as well touch on it now since we're talking about it. So a couple of reasons why we're seeing inflation in the system right now. One, there's been a tremendous amount of Fed stimulus in the system, right? We're starting to see some of that unwind. I think that's number one. Two, supply chains. I'm actually going to move ahead because I was going to talk about supply chains on international equities a little bit here. Supply chains have been disrupted because of COVID, but there's other reasons as well, right? So we had COVID. There was not as much demand as a result of COVID. Then we moved out of COVID, well, still in COVID, but we moved kind of to, more and more people are getting vaccinated, more and more people are going out, they're starting to purchase things again, and they just couldn't catch up with that demand. The other major factor is China. Okay, so China has a zero COVID policy. So what's that mean? So if they have a city that has maybe 10, 20 people who get COVID, they shut down the entire city of 5, 10 million people. That really has a tremendous impact on their economy for one, but they're a major exporter to the rest of the world. If you look on the West Coast, there's shipping lines going out for miles and miles, and it's taking days for a ship that's 3 miles offshore to get into port because there's no workers. That goes to Ken's point. We have a lack of workers out there. We have wage inflation. So all these things are kind of contributing to what's really, it's somewhat transitory, I believe, in nature, but there will be longer term trends in certain areas of the market until we can get some of these supply chains fixed up. So overall, I mean, international emerging markets, they underperformed the US equity side a little bit. Some areas did better than others. Specifically, Japan had a pretty good quarter, and also Pacific ex-Japan. So China had a really tough 2 quarters. So if you had any emerging market equity exposure, and China is usually a big portion of that, you had some pretty significant underperformance in emerging market equity as a result of mainly of China and certain areas of Latin America. Because when you think of Latin America, you still have a lot of COVID going on down there. So their economies really just haven't picked up yet because they still have major issues with COVID. And then finally, fixed income. So on the bottom left-hand corner, we have the yield curve. So from our last meeting, not much has happened to the yield curve. It's actually pretty much on top of each other there. We did see rates, some volatile rates. So I think last meeting we were around 130 on the 10-year. Now we're just over 160 on a 10-year. So rates have risen since that point in time. So we have seen that movement. Obviously, that has an impact to the fixed income side of your portfolio. As rates rise, prices go down, and we'll see that when we get into the performance. We had some slight negative performance on the fixed income side of the portfolio as a result of that. Any questions just generally about the markets? Okay. So September was a down month. So the value actually went down just slightly for the portfolio. It was down to 155.7 from $156.2 million. You can see that beginning and ending values. And this is through September, as I mentioned, and I showed you some October summary numbers on the executive summary slides here. You're up more than this now, but on a year-to-date basis through the end of the third quarter, up 8.24%. On a net basis, up over 8%, and we outpaced the index a little bit there of just under 8%. On a year-to-date basis, when you look at the funds themselves, we had your strongest performance with small cap. That goes in line with the first chart I showed you. That outpaced large cap, so that was your strongest performer on the equity side. Areas like international had strong absolute returns, but lagged the US side. And you could see emerging markets that had the lowest return. And I can tell you why that's underperforming the index. There's slight variances between the index and the fund itself. So I can guarantee that's because of more overweight in China in that Vanguard emerging market stock index than there is in the index it matches up against. So that's probably why there's a little bit of underperformance there. Core fixed income, I talked about this a minute ago. So you do have a negative 1.37% return there. It did outpace its index, but that's where you would expect to see negative returns in a rising rate environment. So high yield bonds actually added to the fixed income, had very strong returns in the fixed income arena. So when you put those two together, it muted a little bit of that downside. Core fixed income, while you might say, let's take this entirely out of the portfolio, we think rates are going to rise. But this is kind of your safety bucket here, right? So if the market tanks 10, 20%, core fixed income is probably going to be one of your top performers. So it's kind of your safety net in the portfolio. But Ken and I, and Ken will speak to this a little bit more, we're having discussions around asset allocation and ways to diversify, and fixed income is probably part of the equation that we're looking at to make some adjustments. We just had a call last week. And real estate, okay, so Ken and myself talked about the inflationary environment. Real estate, REITs, commodities, treasury inflation protection securities, all those asset classes do very well in inflationary environments. This is a perfect example. You're up over almost 26% in the real estate fund because we hit an inflationary environment, and those asset classes did much better than the rest of the asset classes. And this is just calendar year, just another way to look at it. So just going back up. So you're up 11.9% year to date through the end of October. Any questions?
Nope.
Okay. That's all I had.
Thank you, Pat.
Thank you.
Okay. Next up, Sageview.
Okay. Thanks. I'm going to share my screen, John, if I can.
You should be able to.
Okay. Are you guys seeing it?
Yes.
Yes.
Okay, perfect. All right. So I'm going to kind of piggyback on what Pat was talking about, particularly on the fixed income side. The rise in the interest rates that we've seen. And again, looking at the bottom chart, the yield curve, as Pat mentioned, pretty flat in the in the third quarter, but certainly we saw some rising interest rates, over the course of 2022 so far. And the good news there is that while the bad news is it actually lowers the returns on the fixed income assets, it actually also lowers the liabilities. And so you're actually in a better funding status as a result of rising interest rates and the fact that assets have grown as significantly as they have. So just recent conversations that I've had with the actuary, it appears that the plan is about 95% funded, at this point, has a funding status of about 95%, which is significantly higher than it certainly has been. So that's something that is extremely significant. And again, the question ultimately is, where do these interest rates go? Pat made the case that it's likely that we're going to see interest rates pop again next year. Again, from a liability standpoint, that's actually a good thing. That actually lowers the liabilities and can become more, better funded. But ultimately, we're going to see whether those interest rate rises occur across the yield curve itself. There's some evidence that the yield curves may be flattening a little bit, where shorter maturities are actually rising quicker than longer maturities. And, again, the impact that might have on the funding status is something that we'll want to pay attention to. So ultimately, very good news story here, and we'll want to see, and we'll talk a little bit in a few minutes in terms of some asset allocation implications on that. I just wanted to, again, highlight a couple of funding or compliance issues in terms of the funds themselves. As Pat mentioned, the performance of the funds have generally been very strong, both on an absolute and a relative basis. The far right-hand column that we're looking at here is that SageView ranking. That's basically what we look at from the investment policy standpoint in terms of monitoring the funds themselves. If we end up with our score collectively for the funds as in a green status, that means that they pass and the funds continue to pass, as we can see, top decile, and top quartile for the actively managed. Historically, looking at it, going back, through the fourth quarter of 2018, again, all green. So, the funds, have been doing very well. And the collective score, if we look at all the funds together, has a score of a 12. Again, the lower the score, the better. So almost top decile when you're looking at these funds compared to what other funds that you might be able to invest in over time. So the strategy has worked, historically. As Pat showed, the returns are much higher than what the expected return that the actuary is looking at. And so the question is, is it time to consider any changes? The old adage, if it ain't broke, don't fix it. Some of that may be true, and I think part of it is looking at it philosophically from the board's perspective in terms of what the goals are, what the objectives are. If in fact, the board wants to look at a strategy that could produce even a higher expected return than what you're looking at, then we may want to look at some changes to the strategy. If we're trying to generate lower volatility of the overall return, again, do we have the right strategy in terms of generating a good return with lower volatility? Are we trying to lock in that funded status, where we're trying to match the assets to the liabilities? If we wanted to do that, we would probably take more of a fixed income approach and maybe even a longer duration fixed income approach. Does that make sense in the environment that we're working in, where we expect interest rates to rise, where that may actually impact negatively on assets? But that's something that that you may want to be thinking about. Or is there some other philosophical reason to look at making some changes? So As Pat said, we've been talking, in terms of looking at different strategies to see if there's any significant changes that might occur. And I'd love to engage you to see if there's any thoughts that you might have in terms of what you're looking to have the strategy achieve in terms of a result. So I throw that out to see if there's any discussion that we could generate at this point.
This is Carol, and I say thank you, Ken, and thank you, SEI, because I hear nothing but good news.
Well, the good news, Carol, is that we will be back to you even when there's not good news, but it's been a good news scenario. So we're happy to be able to report on that. But yeah. Any other thoughts? I know that Pat and I have also talked about some tweaking at the asset level itself, and there's some interesting product that SEI has that might be advantageous that we're kind of vetting out, from a due diligence standpoint. So at some point early in 2022, we're going to be looking at those to see, even if we don't make any changes to the strategy, is there maybe a tweak here or there to a couple of funds that might make some sense. But any other thoughts on the strategy itself? Does it make sense to be looking at anything different?
Ken, this is Jason. Just so I understand. So we're trying to basically protect all the growth we've had going forward, but also we kind of have to outrun inflation as well. Is that what you're?
Correct. And again, there's a way of protecting the liability by matching that up to the assets. That's called liability-driven investing, LDI type strategies. The challenge with that is, in order the liabilities generally have what they call a longer duration than the assets. In order to match that liability to an asset, you'd have to go out to a longer term bond, maybe a 20-year bond, a 30-year bond. In a rising interest rate environment, you're going to match the liability, but the assets are going to go down. So the liability goes down, but the asset goes down. So does that make sense, in this environment? So if you were a corporate plan and you were looking maybe to terminate the defined benefit plan, which unfortunately a lot of corporate plans are doing, then what you really want to do is to make sure that you are matching that liability, and that might make sense at that point. But an ongoing plan, probably in this environment, probably doesn't make sense to go longer term in terms of the duration of the bonds themselves. And the other issue is that when you go to a higher fixed income allocation, your expected return is going to go down, and that has some implications from an actuarial standpoint in terms of how they value that. Right now we went from 7.25% to 7%. If we went to a higher fixed income allocation, we probably would need to drive that number down even more. That might have some longer term implications on the funding
budget. Yeah.
Contributions. Yeah.
Asset allocation.
Yeah. Correct. So,
Just a quick question.
My thought here is, at this point in time, the strategy certainly has worked. You're not overly aggressive. You've got about a 57% allocation to equities, 3% real estate, 40% fixed income. That fixed income is not long-term in nature. And so it seems to be a strategy that bodes well to where we think the markets are going. And even if it doesn't, it has some wiggle room in terms of being able to react to the market.
Yeah, it's Jason. It's Jason again, real quick. Just for my own knowledge, and actually Mark may be the one to ask, has our plan ever been at 95%?
Funded?
Yeah, I mean,
funded.
yes. There were years for a very long time where we were significantly overfunded.
Okay. Just curious.
So we're creeping our way back to that, or at least maybe we took a broad jump towards that. I think we were pretty much about 80% for a while, over
Quite a
the last
while.
couple of years. Yeah. So this is a good news scenario.
So I lean towards keeping the same strategy. In terms of tweaking the assets, does that, do we need a separate meeting or do you think we can handle that in a regular meeting? You coming back in the spring and
I think we could do it, at least the initial, thoughts and recommendations. I think we could do it at our normal meeting. If in fact it seems to be running longer, maybe at that point we would want to set up a separate meeting. But I
Right.
think at this point we can at least make the first go at, doing it through this meeting.
okay, sounds good.
Okay, great.
Any other questions?
So, John, I think at our February meeting, won't we have the actuarial assessment for the budget?
Should, yes.
Should, okay.
Which would be helpful. The only other thing that I wanted to add was, I think, Mark, you may have brought this up at the last meeting where we asked a question about pension obligation bonds. Does it make sense to,
Yep.
to look at that? And I think, I know SCI, has at least a couple, maybe a few clients that have that. And so I'm going to ask Pat to kind of speak, from their perspective in terms of, does that make sense? Or, why did those clients move in that direction? My thoughts on that, speaking with, a lot of people at Sageview and, was obviously it makes sense if you can guarantee or at least have a really high probability that the return that you're going to generate is greater than the interest that you've got to pay on those bonds themselves. So that's a first and foremost. However, even that said, there's not, it doesn't go without risks. You are taking on a debt, and you've got to pay back that debt. And I know the structure of how that debt is paid back is important. If it's an interest only structure at the beginning, you're kind of back ending it, that could kind of put the burden on future taxpayers as opposed to making sure that it's done over time. So the structure of it would be very important. You are taking on leverage. That's really a good thing if the markets cooperate. It's not such a good thing if the markets don't cooperate and it goes south on you, which obviously could happen in a shorter period of time. And because you're adding to the assets, there's increased volatility to those assets. So again, it's a bigger function of what the markets will do for you. So it certainly can have some play to it, but I think it's prudent that everybody goes in, with an expectation and a knowledge of, what the risks are accordingly. So.
Yeah, Ken, thanks. I mean, I was looking for us or hoping we would, get into a little bit more detail in terms of that analysis and because, I think there is a window, it's still open, but it looks like it's going to close with respect to really low, historically low interest rates to borrow money. And my only thought was, I don't know much about it at all. I know Norwich has done it. And I'm sure there are other towns that have done it. We've made significant gains since the last meeting in terms of what our, how our underfunding amount is significantly less than it was. But the thought was, if we were to do it, the thought would be, well, at least in my mind, we wouldn't want to do it unless it somehow benefited or lessened the annual contribution that the town has to make to either pay for the bonds or to deal with the actuarial shortfall on a annual budgeted basis. That's all. So I was kind of thinking we would at some point kind of do a little workshop on it or something, but my sense is we may be running out of time from the.
And I will add, Cindy and I have done kind of our own research and we're not inclined towards it at all, but we could certainly talk about it more.
Primarily due to our funded rate.
Yeah.
And part of that is, obviously to take out, bonds in this, for this area, perhaps, loses the ability to take it, somewhere else down the road. So Again, we can certainly, work with Hooker and Holcomb to, see the impact that would have on the contributions levels, if in fact you think that was something that you would want to pursue. Pat, any real quick, why some of your clients have chosen that route?
Actually, I wanted to introduce John Waite. He's Chief Actuary, works on our advice team back at SEI. Is he still here? I can't see him in the picture.
Yes.
So
I am here.
Okay, hi, John. So I wanted to just pass it off to John because he has experiences with a few of our clients. So I just wanted him to share kind of high level what that experience was. And then obviously, if there is some sort of workshop that we have together, he would definitely be an integral part of that workshop.
Thanks, Pat, and good afternoon, everyone. Yes, we have gone through a pension obligation bond analysis with a number of our clients over the past. It's incredible. It's 9-10 years. I mean, we've had it's been that long. We've had these low interest rate environments.
Yep.
And our approach to this is that looking at it from a pension only perspective is one-sided, because of course, if you get that influx of cash, it reduces your ADC, your actuarially determined contribution, and the pension looks rosy. But you need to look at it from the holistic perspective, that what is the impact on the town of having to make those service payments on the debt, and also what's the total unfunded position. So if you take out this bond, as has been pointed out by a couple of people, put the funds into the pension. Now you're going to invest it perhaps in a higher, hopefully expected return in portfolio. What if you don't get those returns in that portfolio? Now you still have contributions there. So what we've done is take a look at it from a holistic perspective. What is the total impact on the town, pension plus bond service, with and without the bond? So, what's the pension contribution and unfunded? What is the before the bond? What is the scenario if you have a bond and fund the plan up to whatever level, 100%, maybe a little lower, maybe a little higher, and then adding in what is the impact on the town of that debt service, and any potential changes in funded status in the pension after you put those funds in. And what we've seen is that oftentimes in these very low interest rate environments, it takes an extreme event to bring us to a position that is negative for the bond issuer. That's not to say that this is we're giving the green light. I'm saying we should go through the analysis and make sure that you, as the plan trustees, understand what those impacts are, what the potential impacts are in normal, but more importantly, in poor environments. And is that something that we're comfortable with? It is still a very low interest rate environment, and my expectation would be that pension obligation bonds at this point still make sense, because the expected return on the other assets over a multi-period horizon. We're not just looking at a one-year period. We're looking at multi-years for the pension fund. Are expected to outpace the relatively low service on that bond. And we would also want to be talking to you at the same time about what the de-risking strategy is for the pension fund. Pension fund very different from a corporate pension fund. We don't see the funds come in, reach 100%, and then we can just take risk off the table because it's a balancing item. You've got that actuarial rate that does not fluctuate with market rates, 7.25%, your last actuarial valuation. We want to make sure we de-risk the plan in concert with your actuary's expectations and a strategized path to make sense. So, but I would recommend that if this is something you want to look into, we can collect some information from you, do some analysis. We do not do bond pricing, and we do not do market evaluation of credit impacts or of service levels, but certainly we have the analysis capability to look at what the impact is on a Monte Carlo range of scenarios, deterministic as well as stochastic range of scenarios, to make sure that you understand what the impacts of this strategy might be.
Thank you, John.
Thank you, John. That's all we had from Sageview. So we'll look forward to again continuing this discussion if that's a direction that you wanna at least explore in more detail. We certainly can do that collectively with SCI, and we'll certainly be looking at different product choices, alternatives to be looking at for next quarter as well. Any other questions for me?
Well, for what it's worth, I mean, personally, I wouldn't mind going through that analysis, or at least start to go through that analysis, just so, it's a learning experience. But I certainly will obviously defer to others. If the
That's fine
groups-
with me. It's, doesn't hurt to go through it and see what's what.
Jason, I agree too. It'd be nice to go through the process and just see what it looks like and how it affects the town.
Okay.
This is Carol. Is this bond going to replace what the town has to put in? I'm not sure what it is.
The bond can be sized at your July 1st, 2020 valuation. I'm looking at the report by Hooker and Holcomb. You had an unfunded liability based on your 7.25% discount rate of $30 million. So the bond could be sized. We've had clients that put in about, and that $30 million has decreased over the past year because your returns have been very nice. But let's say it was $30 million in unfunded liability. You could decide to put in the $30 million. You could decide. I've had clients that have looked at it and said, we're going to put in $20 million in a pension obligation bond and $10 million out of general assets that we happen to have in order to reduce the service on that bond. So it can be any mix and match. The analysis we can do is to take a look at, what are a couple of different scenarios? What if we had no pension obligation bond, and what if we had a pension obligation bond that funded that entire amount up, and I would make up some service on that. Let's say it's 1.5% per year service, and we could then modify that once we get information on what reasonable rates are by the underwriters, if we decide to go down that path.
Okay, I guess I'm confused as to, I know the town has to contribute to the pension
This
fund.
doesn't eliminate our.
And
Well,
would that eliminate that?
It does not eliminate it. Your contribution is made up of two pieces. One is the accrual of benefits by the current employees, and one is amortization or pay down on that $30 million of unfunded liability you have. So if we eliminate the $30 million in unfunded liability, now you're just paying the accrual of benefits, which is about $2 million a year.
Okay.
Versus your contribution, I think it's been running $4 to $5 million the past few years.
Carol, it probably won't eliminate. I think I know what you're asking. It won't eliminate because other factors aren't stagnant. I mean, the market could go south, and after we've made up this gap and think that we're at 100% funded, the market could go south, and the town is going to have to make, because of the ordinance, is going to have to make that up. But it is, I mean, to me, it's at least work. I mean, if we did it and the market went south, the town would still have to make a contribution, but hopefully it would be significantly less than if it went south and we weren't at 100%.
Okay.
Yes, that is the goal. Now, you're going to have a contribution in any case. If this plan was 100% funded, you still have to pay for the annual accrual of benefits by the employees.
And
So there
the
are
debt
accruing
service.
benefits each year, the normal cost,
Yeah.
and that's about $2 million. So that is going to continue on unless unless the bond plus any other assets exceed that or returns exceed that. It's difficult to fund the plan up over that 100% level. But so I would expect about $2 million a year.
Well, let's plan on putting that on the February agenda then, if that works.
We'll do the work on our end. We'll be back to you.
Great, appreciate it.
All right.
Any other business before we go to the meeting schedule?
I just want one more question. The asset allocation changes, that's a wait and see proposition, correct?
That's correct from our standpoint. Again, if you were to tell us there was a different philosophical change in terms of what you're looking to achieve, that might drive some asset allocation proposals. But from what I'm hearing, other than the potential for pension obligation bond to be incorporated here, I think it's keep it what it is, and we'll have some different tweaks from a product standpoint in terms of some asset, and we'll bring that to your attention at next meeting as well.
Thank you.
Okay, thank you. Moving on to the regular town meeting schedule for next year. And everyone, any issues with that schedule? I'd entertain a motion.
So moved.
Mark moves. Is there a second?
Jason, second.
Okay, thank you. Any discussion? If not, all in favor say aye.
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 All opposed, same sign. Motion passes. And so now we have 2 openings on the board. So if anybody knows of any, we'll try to do more for advertising, but if anybody happens to know people that would be a good fit, please throw the word out there. So other than that, our next meeting is February 10th. And again, thank you, Dennis. And then thanks everyone else.
Thanks, everybody.
Thank you.
Thanks.
Good luck, Dennis.
Good luck, Dennis.
Happy Thanksgiving, everybody.
Happy
Thank
Thanksgiving.
Happy
you.
Thanksgiving.
Take
Be safe.
Yeah, bye-bye.
Oh, do we need a, I forgot, do we usually do a motion to adjourn? I just blinked.
I move we adjourn.
Okay.
Second.
Okay. Okay, all in favor, say aye.
Aye.
Okay, thank you.
All right. See you, everyone.
Have a good week.
Be well.
You too.